Welcome to Pro Webcast News, where we bring you daily industry updates. Today is Tuesday, August 18th, and you're watching the Afternoon Update with Paul Wilson. Today's news is sponsored by Covenant Reliance Producers. We build success stories. For more information, please visit www.crproducers.com. Now for today's headlines. A group made up of more than 20 attorneys general is pushing Congress to quickly move forward on a new federal policy that would create a federal agency charged with regulating financial products. The group reportedly sent a letter to lawmakers involved with the key financial committees that would create the Consumer Financial Protection Agency. According to the letter, quote, "The current financial crisis, caused in part by irresponsible subprime lending and inadequate oversight, has demonstrated the need for comprehensive and effective consumer protection and enforcement at the federal level," unquote. The proposed agency would prevent vulnerable customers from being exposed to potentially dangerous products and would have the authority to write and enforce rules related to both products and services. Meanwhile, many in the industry have criticized the proposal, saying it would add unnecessary layers of expense and regulation. In related news, a former financial advisor with R. Allen Stanford's company this week told a U.S. Senate panel that she told the SEC about the firm's questionable practices 5 years before the company was closed and Stanford was accused of running a Ponzi scheme. Layla Wilder said she was fired by the company in 2002 after refusing to sell certificates of deposit offered by Stanford's banks. She said she again warned the SEC about the CDs in 2004. She believes she was fired because of her reluctance to sell the CDs. Meanwhile, the SEC has accused Stanford and other former company officials of running a $7 billion Ponzi scheme, promising elevated returns to 200,000 investors on CDs from an offshore bank, and then using the money to pay off old investors with funds from new investors. The SEC today announced that it will seek additional public comment on a proposed alternative uptick rule that would only allow short selling, quote, "at an increment above the national best bid," unquote. In April, the SEC proposed two separate approaches to limit short selling. Under one proposal, an uptick rule that was repealed in July 2007 would be reinstated. Under this rule, stocks' last trades were required to represent an increase in price before short selling could occur. The alternative proposal would restrict shorting a stock at a price lower than the last best bid price, while three proposed variations on circuit breaker rules would halt short selling on a stock once its price decreased more than 10% over a specified time period. According to the SEC, the alternative rule would be easier to monitor because it would only reference the current national best bid and would not require monitoring of later bids or last sale prices. The comment period originally ended in the middle of June, but the public will now have 30 days to comment on the new proposal once it is published in the Federal Register, the SEC said. I'm Paul Wilson, and thanks for watching Pro Webcast News. For more in-depth news and features, visit producersweb.com.